Hi, it's Roger Pine from Holistiplan and recording outside still. And that's working for now, but I live in Texas and this is not going to last, this outdoors thing. I probably got about 4 more days before it'll be like 100 degrees out here. So enjoy while we can, I suppose. All right, today I'm going to talk about Solve for Max, which we've taken out of beta. It's available to everybody now. We teased this in a video a while back, but I just wanted to give another look at it. And I also tease, and I will give an answer to this at the end, how can you have a marginal tax of 37%, some huge number, on your next $1,000 of capital gains? I'll explain that at the end. Let's talk about Solve for Max. That's the name we landed on for this functionality, Solve for Max. So I'm going to go to my computer here now. I'm in the scenario analysis screen, and in the income section is this button called Solve for Max. And what we're trying to do here is, this is that case where you have X amount of income and you're trying to do a strategy where you're bringing income forward through a Roth conversion or possibly through capital gains, where you're trying to fill up a tax bracket without going over. And it's kind of a hunt and peck sort of method to try to find that highest value. Solve for Max just calculates the value for us. So here's a 2018 tax return. I'm going to push that button. And there you go. This is telling me that I have $71,500 left within my current tax bracket. So I can add that much before I get kicked into some higher bracket. And capital gains, similarly, I can add $114,000 more of capital gains before I start having to pay some more amount of money. Now, I should have been careful there. It's not the tax bracket. It's whatever the next marginal tax rate may be, because you could remain in the same ordinary income bracket, but because you've added income, you're bringing Social Security into the mix, you're bringing net investment income tax into the mix, some of these other things that may actually increase or lower your actual all-in marginal rate. So that's Solve for Max. It's just a button right there on scenario analysis. But what if I want to kind of keep going out there? What if I want to hit 2 brackets? Or what if I want to actually drop my income to try to drop myself down to the top of another bracket? Maybe I overshot. So that's this field called Range Calc. It's going to pop up another screen. Click that here. And this is giving us a curve. So it's the same tax return. You can see at no change, where I am now is I'm in the 22% marginal bracket. But as I start to add income, remember, what was it, 71,000 something or other. When I hit 71, once I start jumping up to 72,000, now I'm in a higher tax bracket. And now what I have with this screen is I'm able to see, oh, look, if I keep taking it out, oh, it jumps by 3.8%, probably NIIT, right? And so on. And there's some funniness here when I drop down as below as well. So that is the Range Calc, we're calling it, screen. So it can kind of give you a full curve of what's going to happen every time that you add another slice of income. And that's important because that's how it calculates, okay? What we do is to build this curve is we just take the baseline, which is here's the income today in this scenario, and then we add X amount of dollars, $1,000. And then we say, okay, you added $1,000 in income, the total tax amount went up by $220. Okay, that's a 22% marginal rate. Let's add another $1,000. Let's add another $1,000. And as you keep going, each time we're doing the full tax calculation. And so we're going to reach a point where adding that next $1,000 kicks you into some other amount of tax other than that $220 or 22%. And that's exactly what's happening on the screen here. And so that gets back to how you could have capital gains taxed, or the marginal impact of another $1,000 in capital gains. That could be something other than 15 or 20%. And I've actually got an example right here. Let's scroll down here. So you see this little artifact here. So where we are today, this taxpayer, if you add $1,000 in capital gains, that is taxed at 22%, or rather the marginal impact of that next $1,000 is 22%. And we've had people write in because, remember, we've had in the scenario analysis a little section that says your next $1,000 is taxed at X. And they say this is wrong because you can't have capital gains create 22% in tax. And that's normally true except when the taxpayer has a capital loss. Because remember, up to $3,000 in losses, your capital loss counteracts ordinary income, right? There's that $3,000 cap. But between that $0 to $3,000 range, every dollar of capital gains is counteracting a dollar of ordinary income. And so if we add $1,000 or $100 or $1, if we add capital gains, that's actually reversing out. Now, again, if we're only within that slice, this is the very narrow slice there, we're reversing out that amount that's counteracting ordinary income, and therefore the impact is going to be at your ordinary income rate. And so it just so happens that this taxpayer, remember, they're in the 22% bracket. If I scroll up here, that's where they are. They're in the 22% bracket. But they have a capital loss, I guess, of somewhere between $0 and $3,000. And so adding just a little bit of capital gains actually creates $220, 22% in taxes for them. Now, once that's all used up, now we get dropped back into the 15% bracket. So once you go into no losses on capital gains, you hit 15% and it kind of behaves like normal. So it can happen. And so a lot of times you'll see this spike in capital gains, in this capital gains graph, because of that fact that in that little tiny sliver, the impact of adding X amount of capital gains is actually going to be your ordinary marginal rate. That is Range Calc, Solve for Max. We think it's going to be a really, really helpful tool for kind of playing with numbers. And this is a year we're going to be playing with numbers because RMDs have been suspended. We're maybe playing with new ways of looking at charity. So, and income's potentially down for a lot of taxpayers. And so from a planning perspective, if we're looking long term, we're going to probably be doing more of this sort of stuff this year than in maybe any other years of our career. So we're glad to have this tool out there for you. Take a look at it. Let us know what you think. Thanks.